MDA presents Capital Cost.
Dr. Mauricio de Anda Hernández.
Ever wondered how businesses decide on what investments they should make? What criteria do they use to determine whether a project is worth pursuing or not? Well, it all boils down to a fundamental concept in finance known as the cost of capital. Intriguing, isn't it? Picture this. You're a business owner and you're considering a new project. It's a significant investment, and you need to know if it's worth your time and resources. How do you make this decision? You turn to the cost of capital. Cost of capital, in its simplest form, represents the hurdle rate that a company must overcome to generate value for its investors. It is the minimum return that a business needs to achieve to satisfy its investors, be they equity holders, debt holders, or preferred equity holders. Think of it like this. It's the rate of return that a company would receive if it invested its money elsewhere with similar risk. If the company's return on investment is higher than its cost of capital, the investment is worth pursuing. If not, it's back to the drawing board. Now let's paint a clearer picture with an example. Imagine a company called Tech Solutions. They're considering $1 million project. The cost of capital for Tech Solutions is 10%. This means that Tech Solutions needs to generate at least $100,000 of profit from this project to satisfy its investors. If the project is expected to generate more than this amount, it's a green light. If not, it's a red flag. But how does a company determine its cost of capital? It's a blend of the cost of equity and the cost of debt. The cost of equity is the return required by equity investors given the risk of the investment. The cost of debt, on the other hand, is essentially the interest rate the company pays its creditors. A company's overall cost of capital is a weighted average of these two costs, known as the weighted average cost of capital, or WACC. The cost of capital serves as a vital tool for financial decision-making. It helps businesses assess the risk and potential return of different investment opportunities, thereby guiding them towards financially sound decisions. To recap, the cost of capital is the minimum return that a company needs to generate to satisfy its investors. It's the yardstick against which potential investments are measured. It's calculated as a weighted average of the cost of equity and the cost of debt, known as the WACC. And most importantly, it's a key component in the decision-making process for businesses. So next time you're pondering over a business decision, or simply wondering how companies make investment decisions, remember the cost of capital. It's the financial compass guiding businesses towards profitable destinations.